In this video, we're going to be doing a brief stock analysis of Carrier Global, ticker symbol CARR. And some of the things we're going to cover include just exactly how they make their money and what products or services they provide. We're going to look at some of the financial metrics and definitely look at their recent Q4 earnings results, which they just posted a week or two ago. So we're definitely going to look at that. And we're also just going to look at how the stock price has trended over time and look at my current position in them. Hey, what's up guys? Welcome back to the channel. If you don't know, my name is Frank Mularcik, and I've been doing this series on my channel where I review each of the stocks in my portfolio and just do a brief analysis on them just to give you guys an understanding of what the company does and why I invest in them. So I will leave some links to those up here and in the description below if you haven't missed those. And as always, make sure to like the video and subscribe if you haven't already, because that's just a great way to show me your support, and it's completely free for you to do. So somehow the clip that I recorded the other day, just going over the company, got deleted, or I can't find it. I'm not sure what happened, but I'm just going to record this quick segment right here, just going over the investor relations page of Carrier. So they say they're a global provider of sustainable building and refrigeration solutions, and they are committed to making the world safer and more comfortable for generations to come. So just looking at their fact sheet, they have about $19 billion in sales in 2019, with about 50,000 employees and many different brands, 80 plus brands. And then if we go down here, they have these three basic businesses, which are HVAC, refrigeration, and fire and security. And these three brands are obviously basically they're different business segments, and this is how the revenue and profits and everything is divided up on their balance sheet and their financials, not their balance sheet, their income statements and their cash flow statements. So this is how they separate their business into these three sections: HVAC, refrigeration, and then fire and security. So we're just going to look at some of the fourth quarter results and also go over some of the full year 2020 results as well. So basically their highlights for the 2020 year: sales and profits exceeded outlooks. It says GAAP EPS is $2.25 with adjusted EPS of $1.66, and they reduced long-term debt by $1 billion and net debt by more than $2.8 billion since the spinoff. And if you don't know, the spinoff is referring to the spinoff that happened last April from UTC. So I believe Carrier, Otis, and Raytheon basically all spun off and separated to become their own companies, just to focus more on their own businesses, because sometimes when you have a lot of businesses together, they can just kind of get downtrodden, and they just don't have enough energy to focus on the specific business segment that they're in, So even though they were sort of in similar industries, it's still definitely a different business. So I think generally spin-offs like this are good things. And also just a reduction in debt, I think that's a pretty healthy amount considering their market cap's only around $35 billion. So it's not like they're a huge company. So $1 billion of debt is fairly substantial, I think, to decrease. So for the fourth quarter, sales of $4.6 billion, driven by strong demand in North America residential HVAC, GAAP EPS of $1 and adjusted EPS of 31 cents. And then these results basically included $50 million in a vendor contract termination. So I was listening to the earnings call and they kind of talked about this a little bit. So basically what happened is they had a contract with a vendor before the spinoff, and then after the spinoff, they decided to terminate that contract so that they could renegotiate it later, basically on better terms for themselves. And in the long term, that's going to benefit them more, but they did have to basically pay a $50 million fee because of the terms of the agreement. They had to pay that in order to get out of the agreement. And they prepaid $1.75 billion term loan credit facility. Then they provide the outlook for 2021: sales growth of 6 to 8%, organic sales up 4 to 6%, and currency translation to add about 2%. And then they said that they expect adjusted operating margin to be around 13.5%, up 70 basis points, and EPS to be around 185 or 195, which is up about 14% or more or less, depending on where in that range they're at. And then they're estimating free cash flow of $1.6 billion. And the one thing I saw that I really liked here was they announced a share repurchase program on February 4th. So they authorized their repurchases of up to $350 million of the common stock. And again, on the earnings call, they talked about this a little bit. Basically, they have some stipulations in some of their debt and other contracts of the like that may limit them from the amount of repurchasing they can do, but they hope to meet that whole $350 million repurchase amount in 2021. And for the full year results, their sales were around $17.5 billion in 2020, which was down about 6% compared to the prior year. And it does say, as expected, the decline was largely driven by the COVID-19 pandemic. However, there was some strong demand in North America in the residential HVAC segment, like I said before, in the second half of 2020, which kind of helped them a little bit. And then they said GAAP operating profit is $3 billion, up 24%, and their adjusted operating profit was $2.2 billion, which is actually down 19%. So that's interesting to see. And the main reason that the operating profit was up, or not the main reason for the GAAP operating profit, that is, but one of the reasons is they had some shares in this company Bayer, which they sold in, I think, September and December for some pretty nice profits. And also I did like that they addressed basically their reasons for operating profit being lower. So they said it was impacted by investments in growth initiatives, lower sales, and unfavorable productivity due to factory disruptions related to COVID-19. So basically COVID-19 slowed them down in a variety of ways that kind of all came together to overall lower their profit margins. And we already covered the EPS there, and then net income was $2 billion, and net cash flows were $1.69 billion. And then they had free cash flows then they had capital expenditures of $312 million, and that leaves a final free cash flow of $1.38 billion. And that does include, basically they had profits on those sale of common stocks, so they had to pay around $272 million in tax payments for the sales of that stock, so they did include that in the free cash flow. So they do talk about the fourth quarter results in depth a little bit more as well, but essentially they were pretty similar to the whole year, just that sales were up 2% compared to the prior year quarter, and then they said that the residential HVAC unit basically was up 25% compared to the prior year, which is pretty great. And GAAP operating profit, like we said, was $1.25 billion, which was up a lot from the year before, but adjusted operating profit was $453 million, which was down 24%. So basically, there's two things that are skewing one of those up and skewing one of them down. So like we said, the sale of those Bayer shares is basically skewing the GAAP profit up, and then all of the expenses, one-time expenses that we talked about, like that vendor contract termination, basically skewing the adjusted operating profit down. So overall, I think their general performance was somewhere in the middle, so their net income was $884 billion and adjusted net income of $280 million, with net cash flows of $199 million and capex of $161 million, which leaves a free cash flow of $38 million. All right, so we looked at some of the financials and recent results. So let's take a look at the dividends, because ultimately this is in my dividend portfolio, so I do want to have some sort of dividend amount that's going to be able to pay me. So basically their current yield is around 1.29%, and their payout ratio is 25%, which is obviously stellar, but they do have a fairly low yield. And since they are a spin-off, this year is their first year of dividend growth, so they have 0 years. And actually I was pretty disappointed because they were a dividend at risk wrap before with UTC, and then usually how spin-offs work is if the dividends of all of the spin-off components combined is the same or greater than the dividend of the previous company, then it will keep that status. So some examples of this were with AbbVie and Abbott Labs. Basically their dividend when they split was the same or greater than it was before with Abbott, so then they each kept that status moving forward. So I thought a similar thing was going to happen, but basically at the end of 2020, I realized and I heard somewhere that that was basically not the case. Basically, all the companies combined didn't pay enough dividends to keep that streak alive, so they did lose that streak, but I'm not exactly sure if it was their fault or maybe some of the other companies that didn't hold that up. So that is unfortunate, but it is a new company in regards to being publicly traded by itself. So that's just part of it, part of the game, I guess. The one good thing is they did increase this dividend significantly. So the first two dividends they paid were 8 cents a share, and then they increased it to 12 cents a share for the upcoming payment. I think I actually got paid a few days ago, so that was pretty nice to see. So it was a nice 50% increase. So just looking at the stock price over the past almost a year, they spun off around the beginning of March or April. I thought it was more April, but it looks like they have stock price history back till March, and I probably bought in sometime around April or May. So they have increased pretty nice here over the last year, over 100%, which is pretty fantastic. And I have over 100% gains on my personal position. So they have a market cap of about 32 billion, and that PE just looks pretty nice at this point to me, around 16.5. So that definitely could be a sign that they're undervalued. Obviously, PE probably isn't the absolute best metric, but it is one factor to consider, I would say. So just looking at my Fidelity account here, basically Carrier is right here in the rankings, which is pretty interesting because I've already covered Travelers and Aflac. It seems that they've just been doing pretty well recently, so I guess they've just passed Carrier up, and I think I have been buying a little bit more Travelers, so that probably contributed to that as well. But as you can see, I have just over a share. Basically, for a really long time, I just had one share, and that was it. And then I, at some point, maybe a few weeks ago, maybe a month ago, I bought a little bit more. So I generally do like them overall. You can see my total gains is around 13%, but I originally bought this company back in April in my Robinhood account. Maybe it's more like May. It's probably like May. And in there, I bought around $16. So before I even transferred over to Fidelity, I had over 100% gains on this stock. So obviously, since the dividend is not that great, it's nice to see I've gotten some nice gains as well. So overall, I really like Carrier. They're obviously in a super stable industry like heating, cooling, air conditioning, fire protection. These are things our society and our world is really going to need always, So they're in a pretty stable industry. One thing I do like that they're doing is they're definitely innovating and continuing to look for new technologies that can help their business. When I was listening to the earnings call, they talked a fair bit about this. They're basically working on systems for air quality in buildings. Given the pandemic, that's like an issue that people are starting to value more, or something that is becoming more important, definitely. So basically just systems and a lot of technology that goes into that to be able to monitor air quality and make improvements and stuff like that. And they have some machine learning type stuff, and they're working with Amazon Web Services on some of that stuff. So that's really exciting for me to see them kind of get into the tech space. Obviously, something like an air conditioner or a refrigerator seems like a pretty boring product. So it's good to see that they're getting into some tech stuff. And obviously, they're not just selling like refrigerators to the average Joe Schmo person for your house. They're selling big industrial type things a lot of the time. So overall, I really like them as a company. I don't think I'm going to be adding much anytime soon. They are fairly small weighting in my portfolio, but like I said, I just like them where they're at. They're paying me a little bit of a dividend, and I'm getting some nice capital appreciation, so that makes me happy. I would recommend you guys definitely doing more research on them, or don't take my opinion for it if you are looking to buy this stock, because obviously I'm just a guy, sitting here with my computer, with a camera, just giving my opinion. So definitely do what you think is right for you, not what I think. So just want to throw that out there because it's really important as investors just to, look to ourselves and really understand what we're getting into, and not just going along with the hype or what other people are saying, because I think people are doing a lot of that these days. I hope you guys enjoyed the video. I will leave some videos up here on the screen of other stock analysis I've done if you want to check them out, and I will see you in the next one.